don't know if we'll get done with it or not, to be honest with you. And next class, we're going to continue with chapter 3, either in the handout or in, we might do a textbook problem or two. We're going to spend a little bit of time on this just because it's a kind of difficult topic. Okay, let's get rid of the Zoom meeting. We're already in it. Okay. And, you know, before I even do this, let me just, here's the idea behind adjusting entries, is to try to get revenues and expenses matched up in the same period that belong in those periods. For example, if I said, you know, these are the revenues for 2021, and I matched it up against the expenses that we had back in 2011, you say, well, that's, you know, it's stupid. It doesn't mean it's meaningless, right? I mean, the expenses in 2011 don't have anything to do with what happened in 2021. So we always try to match up the revenues and expenses in the same period. So whatever revenues we have in 2021, we want to match those up with the expenses we had in 2021. So that is kind of the idea. It's actually a very simple idea, but the actual how it kind of works out as far as what we have to do accounting wise makes it a little more difficult. And the reason being is that transactions will often span more than one period. If they're all in the same period, it doesn't matter. But if they go from one period to the next, and there's a lot of things that do that. If you buy a truck that's going to last for 5 years, well, it's going to go into 5 periods. It may actually go into 6 periods, because if you buy it halfway through the year, you know, you go into the, you know, halfway through into the 6th year. So there's a lot of things that happen for more than one, that happen in more than one period, or that span more than one period. And that's when the problem comes in, because we are trying to match up those expenses that are in that period or those revenues that are in that period, you know, even though the actual transaction may be spanning more than one period. So that's kind of what we're looking at when we talk about adjusting entries. How do we adjust the books so that the revenues apply to the current period and the expenses apply to the current period? Okay. Oops, one thing. There we go. There we go. Okay, sorry about that. All right. Okay, we just talked about commonly you'll see sometimes companies will do financial statements in monthly, quarterly, annual, which is yearly, I guess is maybe another way to put it. So quarterly, monthly, yearly, you know, those are kind of the timeframes usually companies have. Quarterly being every 3 months, and annual obviously every year. And virtually all companies are going to have at least a year on annual financial statements, just to kind of know where the company's going. But if they're publicly traded, they are required to have quarterly reports, quarterly financial statements, and annual. So if it's a publicly traded company like IBM, they're required to have a quarterly financial statements and every year. Okay. I just gave the same boring example that I gave you guys talking. So transaction may not fit into the period. For example, a newly purchased truck might last for 5 years. I gotta change that. All right. Now, one of the problems that we have with our with doing this is that we work on what we call an accrual basis in accounting, and I'll talk about that in just a second. And accruals and deferrals are the two things that kind of make make us miserable doing these adjusting entries, and that's what we'll talk about next. Accruals. Accruals are when the money has not changed hands yet. A transaction has happened, but the money hasn't changed hands yet. For example, we may have accounts payable, right? We bought something on credit. We have the goods or whatever they are, but we have not paid them yet. Okay, so that's an accrual. We're going to recognize that we owe them the money, but we have not paid them yet. And it could be accounts payable, it could be wages payable, it could be interest payable. A lot of times the payables are going to be that. Same thing with receivables. We did the work, but we haven't been paid yet, right? So, these are transactions that would be, in here somewhere that they've occurred, but the money hasn't changed hands yet. So this is accrual accounting, and accrual accounting a lot of times is a little bit more difficult. Deferrals is similar to accruals, but deferrals are when the money has already changed hands or the financial transaction has already occurred. For instance, supplies. We buy supplies, it's an asset. As we use them, it's expense. So we're deferring that expense for those supplies until we use them. Same thing with prepaid assets. We pay for them in advance. We're not going to expense them until we use them. So you buy insurance. Let's say you buy a 1-year insurance policy. You're not going to expense the whole thing right away because this is going to cover an entire year. So as time goes on, you'll expense some of that insurance. Unearned revenue, another one. They've given us the money. So we have the money, but we can't count that as a revenue until we earn it. So we're deferring the revenue until we have earned it. In fact, in governmental accounting, they don't call it unearned revenue, they call it deferred revenue. But anyway, the same idea, though, that accruals and deferrals are basically timing differences. They're both timing differences, basically. And so that's what gets to be a little bit tricky. Accruals are that the money hasn't changed hands. Deferrals are the money has changed hands, but we don't recognize it, or we don't recognize it completely yet. Any questions on that? Okay, and so and these are the things we have to take into account. And again, the reason that they were doing this is because we want to have all the 2021 revenues and the 2021 expenses matched up. Okay. And down here is just kind of a little illustration of kind of what we're talking about. So you may have all these transactions, transaction A, B, C, D, E, and A is a deferral. The money's changed hands, but it's going to go into the future. Maybe you bought a truck and you're going to expense it going into the future. B is just the opposite, that the money hasn't changed hands yet, but a transaction has occurred. Maybe it was a sale. You made a sale in 2020, you didn't get the cash till 2021. You're going to recognize the sale there because that's when you earned it, is in 2020, not necessarily when the cash came in. And so these are all kind of like just, if they're at the beginning, it's a deferral. If they're at the end, oops, let's not do that. If they're at the end, it's a accrual. And accruals are a little bit more difficult to, excuse me a second. Analogy are acting up. Accruals are sometimes a little bit more difficult to identify simply because the money hasn't changed hands. So sometimes not a lot has happened that you can actually see, even though revenue's been earned or expenses have been accrued or whatever. So that, deferrals are usually fairly easy in that the money's changed hands, the transaction is there. But accruals are actually a little bit trickier. And a lot of times when companies miss stuff, they miss it because it's accrual and the money hasn't changed hands. When it changed hands, they would know it. Okay, so that's what it looked crooked to me. I'll mess with it later. Okay, now these adjusting entries, and we'll come back to this when you'll kind of see this when we do it. They always have a revenue or an expense in them. So the journal entries will always have a revenue expense. We're trying to get the revenues and expenses in the correct period. That's the whole idea. So they'll always have a revenue and an expense. Now, looking at our thing up here, you know, we're talking about year ends. You know, this is what we're talking about, year end. You'll notice that the cash has either changed hands beforehand or later, but not at year end. So adjusting entries never have cash. The cash has either changed hands beforehand or it hasn't changed yet. You know, the cash hasn't been paid yet. So, you know, accruals and deferrals, the cash does not, we do the adjusting entry. There's no cash in the adjusting entry because no cash is changing hands at that point. It's either changed hands beforehand or it hasn't changed hands yet. So there's never going to be cash. So revenue and expense, it's never cash. Sorry. I'm getting terrible. It just, I've been sitting at this desk for 2 hours. There's no, all of a sudden I just got it. Okay, so let's take a look here. So first one, and we're going to do, I think 3 of these prepaid ones. And prepaid ones are, these are actually deferrals when you pay something ahead of time, but you don't recognize it as an expense just yet. You're only going to recognize it as you use it up. Okay. Excuse me. All kinds of problems here. Okay, so on April 1st, that's important, they bought a 1-year insurance policy, purchased for $1,200 cash. The cost of insurance is $100 per month. And you can probably kind of see where that came from, right? If they paid $1,200 cash and it's for 1 year, it's for 12 months. So I'm sure you guys have already picked up on this, but stating the obvious, we'll put in. So that's where that comes up. Oops. Okay. So here we are. We made the journal entry. Now this journal entry has already been made for us, so, and this is the correct journal entry. The prepaid insurance went up. It's an asset, went up. The debit credit table over here too. So it's an asset. It went up with a debit. So when we buy the insurance policy, we haven't used it yet. Okay, so prepaid insurance goes up and cash goes down. At this point, we're no better or worse off than we were. We trade one asset for another asset. The assets in total haven't changed, and nothing on the liability, no expenses or anything. This is just a clean one asset for another. Okay, now how much the prepaid insurance was used as of December 31st, 2021? Why did that separate a little bit? Oh, I think I did it on purpose. Okay, so you'll notice that April, we bought this on April 1st. So we had it for the entire month of April, May, June, blah, 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 all the way to December. So we had this insurance policy for 9 months. we've used up 9 months worth of insurance. Okay, so the question is, how much are we going to expense? Oh, 9 months at $100 a month. Oh, there's no L in months, just in case you. Times $100. Oops, it's not 100. So they've used. So how much of it was used up? Okay. Okay, so you used up 9 months. Okay. So we have to make a journal entry. Now notice that we have this sitting in our accounts. Our prepaid insurance account, we had what, 1,200? And okay, so how are we going to adjust this prepaid insurance? We've used up 900 of it. So we really don't have 1,200 of prepaid insurance as of 12/31. You know, on 12/31, we don't have. We've used up some of this. We've used up 900 of it. So how are we going to adjust this account? What are we going to do with prepaid insurance? It's got a debit balance of 1,200. We've used up 900 of it. So what's the journal entry going to be? Just for the prepaid. Used up, expired, however you want to say it. Oh, come on, somebody knows. How much do we have to take out of the prepaid insurance?
Do we credit prepaid insurance 900?
Yep, that's exactly it. So it's an asset going down. So we had to take 900 out of that account. So let me come over here. 900. And on the other side, now remember, these are adjusting entries. So we have the choice of a revenue or expense. Well, I already put it in here. They kind of jumped the gun on it. I shouldn't have. But in this case, it's going to be an expense. This is money leaving us. This is not money coming into us. So we're going to have an expense. So every adjusting entry, you got to ask yourself, is this a revenue or an expense? And in this case, it's going to be an expense. Oh, I'm sorry. It is an expense, but it's an insurance expense. Or 900. And expenses are always debits. Our prepaid insurance account now is down to what, 300? Let's probably put that up here. Now, so yeah, so this will be our ending balance in our prepaid insurance. We have 300 left. It'll go into the next year. Right, we'll use that up in the next year in 2022. We'll use that up in the first 3 months of 2022. But this 900 will be expensed in 2021 because we used up 900 of it in 2020. That's not there. But notice also there's no cash. Why? The cash has already changed hands. The cash changed hands in April 1st. The cash changed hands. So there is no cash down here. So the cash is already gone. Okay, this next one is a little bit trickier. And that I don't tell you how many months there are. So and the 250 per month is just the something we did up here. Do the 3,000. So this is where that 250 per month came. Okay, so I will be quiet and see if you can figure out how many months they had. So they bought this policy on 10/1, on October 1st. They bought the policy. So how much of it have they used up? How many months did they have it for?
3.
Yeah, so October, so they had it for all of October. They bought it on October 1st. So they've used up 3 months of it.
So 750.
Yeah. Did not do a very good job spacing these. I should make this a font smaller. But so they use 750 of it. So coming down, oops, coming down here. 3,000, I think, 3,000. Again, the same as this last one, insurance expense. So they used up 750 of it. So this would look like the prepaid insurance is going down. $750. So the total down here would be 2,250. I think that's what it comes out to. So this would go into the next year. You know, they use, so that $3,000 insurance policy, 750 would be in 2021, and the rest of this would be in 2022. So, you know, we're kind of, you know, the cash has been paid. We bought the insurance policy. Now it's just splitting it up between the years. And again, you know, it's intuitive, and you know, the idea is intuitive and very simple, but you know, it's kind of quirky. You know, part of the quirkiness too is we're using, you know, the 400-year-old shorthand, but yeah, so we're making these adjustments to it. Question on that? Okay. I know what students like more than 2 adjusting entries for insurance policies. They like 3 of them. So number 4, don't tell you anything. They had a 1-year insurance policy. On August 1st, they had a 1-year insurance policy for $600. And you have to figure out how much it is per month and how many months you had it. So I will be quiet as I can. And let you figure it out. How much is the insurance per month?
$50.
Yep. Okay, so that's how much we have to expense each month. Okay, so they made this entry. The cash already changed hands, so there's no cash involved from now on. How many months did they have it for?
5.
August 1st, so all of August. Yep. 250. So we have to take 250 out. Okay, so this is the insurance expense is 250. We're taking the amount that we used up in the prepaid insurance would be reduced by 250. Here's a question for you. If if a company mistakenly didn't do this journal entry, would their income be overstated or understated?
Overstated.
Yeah, it'd be overstated. If they didn't make this journal entry, they wouldn't have this expense. So if you fail to make these entries, your expenses would be too low. So it would be overstated. Would your assets be overstated or understated if you didn't make this entry?
Under.
They'd be overstated.
Oh, sorry, over.
Yeah, because it'd still be 600 basically. So yeah, so if they don't make this journal entry, their assets are going to be overstated, and their income's going to be overstated. So and by the way, if you ever hear accounting people complain about month end, oh, we got closings, they talk about closings or year end closings. This is what they're talking about, doing this stuff. It is a hassle. They don't just complain for no reason. I mean, it can be digging through numbers and stuff. Okay, so number 5, we're going to go into unearned revenue. So this is when someone pays us ahead of time. This is also a deferral. The cash has already changed hands. They gave us the cash, so that part of the transaction is over. But we haven't done the work yet. So this is a deferral. We can't recognize that as revenue until we actually do the work. So we got the cash, but we haven't done the work yet. So November 8th, we got the cash, put it into unearned revenue, which is really not a revenue at all. It's a liability. And okay, so we got this liability for $3,400. They gave us $3,400 cash. It's a deferral. Cash has already changed hands. They're not going to give us any more cash. They already paid for it. At year end, $1,800 of the unearned revenue had been earned. So we actually did the work for $1,800 of the $3,400. So make the adjusting entry. All right. Well, let's see. Here's the unearned revenue account. And there is 3,400 sitting in there. And they tell us that 1,800 I could write that sentence a little bit better than I did here. I don't know. They earned 1,800 of the unearned revenue. So 1,800 of it was earned. So what are we going to do? Let's look at just the unearned revenue. We have a liability of 3,400. We earned 1,800 of it, so we don't owe them for 1,800. So what are we going to do with that account?
Subtract 1,800 from it.
Good. Will that be a debit or credit? It's got a credit sitting in there right now.
Debit. Is it? Do we say like service revenue, or do you just say
That's exactly
revenue?
It could be service revenue or just plain revenue. Either one, absolutely fine. So this is a liability going down. By 1,800, we earned it. We don't owe them that anymore. And then the other side, you're right. We go to some kind of revenue. It could be service revenue. Service revenue is fine. It could be any kind of revenue. So service revenue is 1,800. So we're going to pick up the 1,800, and that's just plain old revenue. We've earned it. Over here, we're going to take off 1,800, and we still owe 1,600. I should take Benadryl, but I know I'd fall asleep, and could be this. You guys put it on YouTube or something. Our teacher's sleeping. He's snoring. All right. So this would be what we left. So we still owe them $1,600 worth of work, but we get to recognize 1,800 of the revenue. And again, this is revenue. Every adjusting entry has either revenue or expense. Excuse me. In this case, it's a revenue. And it's only for the amount that we earn, not for the whole 3,400, and we still owe them for the 1,600. Do I have another one of those? I do. Oh, you gotta do a little ciphering for this one. The customer paid $5,000 in advance. That work your mind worked on. And at year end, 70% of the unearned revenue had been earned. One of the things about construction, a lot of times they will give, they will state how much was done based on a percentage of the total. So if they did 70% of the work is done, and sometimes they'll even split it up between materials and labor and so forth. Because sometimes the materials, you might have 100% of the materials, all the materials for the building or whatever right away, and then it's a matter of putting the stuff together or whatever. So sometimes they'll actually have percentages for different categories of labor and materials and other things. But anyway, they said 70% of the unearned revenue had been earned. So someone goes up and looks at it and says, yeah, it's about 70% done. Telecounting, it's 70% done. So you have to figure it out. So how much have they earned? Dollars.
3,500.
Yep. Okay, so they earned. Hey, that didn't work out right. Supposed to get red. So speed kills. All right. By the way, sometimes revenue by definition is earned, but there's nothing wrong with if you're trying to keep it straight. Say earned revenue. There's nothing wrong with that either. So sometimes you actually see people have accounts that say revenue earned or earned revenue, but by definition, all revenue, if you count it as a revenue, is earned. Unearned revenue is not really a revenue; it's a liability. But if you recognize the revenue, it's earned. But you can put earned in there if you want. That's fine too. Earned service revenue, whatever you want to call it. Okay, so let's see. So we have to debit the unearned revenue, reducing the liability. And we're going to recognize the revenue. Again, no cash. The cash changed hands on this is September 4th. The cash changed hands. There's no they aren't paying us anymore at year end. So it's just the liability is going down, revenue is going up. And our unearned revenue would be 1,500. So this would be what would be left over that they still have to earn. Okay, suppose they failed to make this journal entry. So they didn't make this journal entry. Would revenues be overstated or understated? Well, I sketch it. Sketch. Would income be overstated or understated?
Understated.
Yeah, they wouldn't count this revenue. This revenue wouldn't be there, so they'd be showing less revenues, which would reduce the income. How about liabilities? Would they be overstated or understated? If we didn't make this entry, they'd be so they still have the 5,000 on the book, so they'd be overstated. So the revenues would be too high. Scratch it. The liabilities would be too high. The unearned revenue would be too high, and the revenues would be too low. Yeah. Okay. Let me see this for a second. Okay, I think we'll do depreciation. Let me see. I got 2 here. We'll do the depreciation. I think then we'll stop. Depreciation are generally a little bit easier. Depreciation, again, this is a deferral. You know, they bought the truck. They paid cash on January 1st, so here they are buying the truck. You could also put in an account called truck if you wanted. And then also cash. So this is when they bought the truck on January 1st. Okay, the truck is estimated to last 10 years and then be worthless. Okay, so they're going to use the truck for 10 years. At the end of 10 years, they're going to give it away, and it'll be worthless. So, how much is it per year?
Well, by worthless, do you mean it's worth $0?
Yes.
Okay, yeah, then it's 2,000 per year.
Yeah, so what we're going to do is say, okay, if this thing is going to go down in value by $2,000 every year, now the way that we do this, which would be pretty, sorry. First of all, we answer all the questions. Now, the way that we do this is a little bit quirky, but there's a reason for it. There's a reason why it's quirky. We start out with depreciation expense, which makes perfect sense. There's going to be an expense. Somehow you're going to expense this truck over 10 years. So some kind of expense. The depreciation expense is obvious, but the other one isn't, and that is accumulated depreciation, which we talked a little. It was not actually on the accounting cycle thing that we did for chapter 4. And you remember this journal entry, a very morbid acronym DEAD. At the end of its life, it's dead. So this is depreciation expense and accumulated depreciation. And for depreciation, it's always the same. Depreciation expense, accumulated depreciation. So this would be 2,000 every year. The next 10 years. Now, this accumulated depreciation expense, you guys know about expenses. They go on the income statement. No big deal there. Accumulated depreciation. This is something fairly new. This is a contra account. A contra account means it goes against some other account. It goes against some other account. So it's contra to this other account. And this one is, somebody just, so see this called a contra asset to the equipment account. Oops. Okay, so this is going to go against the equipment account. So this is kind of the wacky one, and we'll see how this works out down here. So this is how you guys actually saw this before. This is what we did in the accounting cycle thing. But this is a little bit more, we've actually done the work here. So this will be under assets. It's probably in our property, plant, and equipment. We don't need that right now, but let's see. Our equipment account would show 20,000. And right underneath it, we'd have this accumulated, oops. Depreciation. And this would be minus 2,000. And so this would be shown on the assets. This would be the net equipment. And a lot of times on the financial statements, when you look at the assets, it'll just say, net, net equipment, net property, net land or whatever it is, net buildings and whatever. So this is what it would actually show as the value of the equipment. Okay, so there'll be other assets in here too. So this accumulated depreciation goes against the equipment. Now you might be wondering, say, well, why don't we just take it right out of the equipment, right? I mean, instead of doing this thing where we reduce, we have this separate account that reduces the equipment account. Why do we do this? Why don't we just take it out of the equipment and just show equipment 18,000? The next year show equipment 16,000. Equipment, because that's what it's going to be anyways, right? So why do we have this in here? Why do we have, this accumulated depreciation in here? And there's actually a kind of good reason why we do this. And I don't think I showed you guys this before. Maybe I did, but let's see. Okay, let's say that we have two assets. Okay, so you have two assets. Let's give these assets some catchy names like equipment A and equipment B. they both have the same net asset value. Right? Okay, so you have two of them. Equipment A and equipment B. And they're both worth $5,000. Now, which one of these is an older asset? Most likely. Is A older or is B older?
A.
Yeah, A. I mean, it's been depreciated almost all the way down. Right? This one's been around a while. Right? So this one is older. And this one, it has some depreciation, but not as nearly as much of it. You know, there's only 6,000, so there's still quite a bit left of that. Okay, so, but even though they have the same net asset value, just by looking at this, you can tell which one is most likely older. Also, which one is more expensive to replace most likely, A or B?
A.
A. So looking at these two assets, well, they might look the same if you look at the net assets, are they identical? In reality, equipment A is old and it's probably going to get replaced probably fairly soon. And it's probably going to be very expensive to do it. You know, not knowing what it is, who knows, but you know, there probably will be a large cash outlay for equipment A, whereas equipment B, it's, I mean, it's not cheap, but it's relative to the equipment A, it's much less. And also, it's probably a newer asset. So even though they have the same net value, equipment A is obviously older and it's obviously going to be expensive to replace it. And if we just wrote off the accounts, these two, you wouldn't know that information. These two look identical. You think they're the same thing. You know, they look like the same size and same age and everything else, whereas actually they're very different. So this is why we have this irritating accumulated depreciation account, because it gives people who analyze financial statements, and really that's what we're doing, is we're trying to give people information so that they can use it to make decisions. And it does give information about that. So that's why we have it. It's there's nothing wrong with thinking about, okay, it's just reducing the equipment or whatever. And theoretically, there's nothing wrong with doing it that way. But it's just felt that the accumulated account gives more information, and that's why we have it. Okay. And this one's kind of the same thing. Versus for 12,000. Last 5 years going to be worthless. Okay. All right, so cost this thing is 12,000. 5 years. So we're going to expense $2,400 each year. Journal entry exactly the same morbid acronym. That's for all depreciation. Journal entry. So every year they're going to make the same journal entry. Well, for the next 5 years, I should say. So every year for the next 5 years, they'll make the same journal entry. What they're doing is they're spreading the cost out. It's okay, we're going to use this machine over the machine. What was it? Yeah, they use this machine over 5 years. Okay, so every year we're going to expense a little bit of it, or 1/5 of it, or whatever we're going to put it, because that'll match it up with the revenues for the year. Obviously, we're using this machine to make some kind of revenues, and it'll match up with those revenues. So 2021's portion is 2,400, and this is a deferral. Cash already been paid. There's no cash here, right? Cash has already been paid, so this would be. He also listed as machine. Uh, 9,600. So this would be. This would be really what the value of the equipment is on our books, because we've allocated that we're going to take off 2,400 every year. Excuse me. So we show the equipment at 9,600. But again, this accumulated depreciation will just keep changing. So, well, here I'll show you. For next year, the accumulated depreciation will go up by another 2,400. So this will look like this. 2,400 plus 2,400 is 48. And this would be 7,200. You know, so this would be year 2. Or I should say 200. Yeah. So in year 2022, this would look like that. In 2023, let's keep going up. So this would be, well, this would be 7,200, right? They switch spots. This would be 48. And just keep going down there until you get to the end of year 5, which would be 23, 24. It look like this. And at that point, they probably dispose of it. Any question on that thing? Okay, we will stop here, I think. Okay, any questions on any of this? And again, we're really just trying to get the transactions to fall within the right period. It's really all we're doing. It's a very simple concept. The actual nuts and bolts of it can be kind of tedious. And again, this is what, when accountants complain about month-end closings or year-end closings, this is what they're complaining about. It's going through all these little adjustment things. And they can, sometimes they can be fairly significant as far as depending on the company, how much, that if they don't make these adjustments, what how far off the books are. Okay, so questions? Okay, are there any questions? I think the chapter 4 exam is due today, I think, isn't it? I'm pretty sure. I am lying to you guys. I'm sorry. The chapter 4 exam is due on Friday. I should have known that. So this Friday, the chapter 4 exam is due. And if you have any questions on it, feel free to ask me either in our sessions or if you want to do it outside of sessions too, that's fine. And basically during the week, Tuesday through Thursday and then even Friday, time obviously, but this is the only class I have. Tuesday, Wednesday, Thursday. This is the only class I have. So if you have somebody you want to meet outside of class or something, that's fine. Before a class, after class, whatever. My Mondays are really tight, but from like 2 o'clock to 8. But the rest of the days are fine. So if you have any questions on any of it, there's nothing wrong with taking the exam, but you're looking through it, and you're off by $600 or whatever it is. You can't figure it out. You can contact me, and we'll kind of go over it. I mean, the whole point of this class is to learn. So yeah. So if you do run a problem, obviously see if you can figure it out yourself. But if you've been through it 3-4 times and you can't see it or whatever, go ahead and contact me, and we can kind of go through it. All right. Any questions? Okay. Well, have a good rest of your evening. We will pick up this tomorrow. We might finish it tomorrow, but anyway, yeah, we'll continue with this these adjusting entries. All right. Have a good night.
Have a good night.